Greg, what's up, man?
What's up, Brad?
Your microphone. You there?
Can you hear me?
Yeah, I can hear you now.
Cool.
There's some static. What's up, everybody? Hopefully everyone's enjoying their Wednesday here on Facebook. Today we are going to talk about the loan estimate. This is a document we're required to share with clients once they complete an application, and it kind of gives them an idea of the costs involved on the particular loan that they're looking at. So, Craig, you're going to kind of lead this discussion. I'll kind of chime in, but why don't we start with you? Where do you want to go with this?
I feel like I just want to, talk about this document specifically because it's one of the most important documents in a mortgage disclosure package. It's kind of a summary document. It tells you your terms of financing, some important features about the loan that you're doing, and most importantly, what people want to know is, what my monthly payment is and how much am I being charged to purchase a home. And we're going to talk about the pages in a loan estimate in detail and specifically go over what are some of the costs or in a scenario when buying a house using conventional financing. This estimate is based off of a standard 30-year fix. But the idea here is not to just focus on the loan itself. It's more of the concepts, the general idea of how a loan estimate works. And most of these terms and figures in the estimate are going to apply to most types of financing, right? So I feel like because this is an important document, we want to make sure everybody is aware, when they look to buy a house, what they're getting into. And this is what most lenders should go over with you. So I don't know if you want to pull that up and then we can kind of get started.
Yeah, I'll just mention a few things. This is required. So there's certain pieces of information that you provide to a lender and they will trigger this document, meaning if you supply, basically, if you take a full application and you know the property that you're going to finance, the lender is required to share this document with you. So if your lender's not sharing this with you, ask them for it. Number two, most of the costs that we're going to go over could change. Some of them could change, but these are pretty standard for every loan type. The only difference is depending on the loan, it will require different down payments. So we'll discuss that as we go over it. Craig, I'll share this screen now. And then I'm just going to kind of follow along with you and try to annotate things as you talk. So I might be a little bit behind.
Yeah, see if we can zoom out maybe so everybody can see the document, and then maybe we can zoom in on sections.
So this is the most I'm going to be able to zoom into it.
Yeah, I don't want to zoom in. I want to zoom out so we can see the entire document.
This is the entire document. I mean, otherwise you're going to see my background.
No.
I understand.
Yeah,
right.
Exactly. So, and again, I just want to kind of, there you go. Perfect. So I feel like everybody can kind of see the entire document itself. So you have at the very top some basic information about when the loan estimate is issued, right? We know that has to be issued within 3 business days of triggering an application. And this is all on the left-hand side. Thanks, Brad. You have whoever is on borrowing money, right? The applicants who are borrowing money, the subject property, and the sales price. And on the right-hand side, and you can highlight that side, it tells you about, the amortization. You're doing a 30-year loan, a 15-year loan, or a 20-year loan. The purpose is related to the type of transaction. Is it a refinance of an existing loan, or is it a purchase transaction? Product. Most of the time, you're going to have fixed rate mortgages right now, just because of how low rates are. Another product type might be an adjustable rate mortgage. I'm not going to concentrate on that because most lenders aren't doing a lot of adjustable rate mortgages right now. Loan type, conventional, FHA, VA. That blank spot might be more focused towards USDA financing, but those are your 4 major loan products offered to the public. Loan ID is just signified by loan number for whomever it is that you're working with, whatever bank you're working with. They have a unique identifier for your loan. That bottom portion is important too, right? It says rate lock. And if you're getting a loan estimate and somebody's quoting you a rate and you want to make sure that your rate is protected for a said period of time, you want to make sure that that box is checked yes, and that it gives you a date of which the loan, or excuse me, the rate would expire. So that's an important area to look at the loan estimate, whether your loan is locked or not. Closing cost expire. This usually has to do with the intent to proceed. So if somebody sends you out a loan estimate and you haven't agreed to move forward with the transaction itself, they're saying, look, this deal only lasts until you intend to proceed, and you must sign that intent to proceed with the particular deal that they offered you by that certain date. So in most cases, your closing costs or your cost from the lender's perspective aren't going to change. This just kind of protects the lender. It says, look, we can't offer this deal forever, so to speak. So that's just the top portion. And then you got some tabs below that kind of explain some more features about the loan terms. We can kind of concentrate on that. So on the left-hand side, it's telling you your loan amount, your interest rate, principal and interest for the loan, and then whether there's some negative features about the loan. So we'll just start at the top row. So you have your loan amount. And in this case, it doesn't really tell you the down payment on a loan estimate on this page. But if you take $240,000, right, and you divide that by 400,000, you're going to get a 60% loan to value, which means there's 40% down payment with this particular scenario. This Andy America guy has a lot of money to put down, but you don't need that much of a down payment necessarily to do a loan. And this is just for example purposes. So the loan amount is 240. And then on the right, you see a question that it asks is, can this increase after closing? So that's important to know too, right? Because with a fixed rate mortgage, you don't want to find out that your loan amount's going up. That would be a negatively amortizing mortgage, meaning your balance is increasing after you close on the loan. That's not going to happen with these standard loan products that are offered to the public. They're very safe, conventional FHA, VA, or USDA. So the answer is no in that situation, and most likely it's going to be no if you're doing one of those products above. Interest rate, can that go up after closing? If it's a fixed rate mortgage, it'll never go up. It's fixed for the duration of the term. So in this case, for 360 payments, it's going to be a 2.99% interest rate and never move. Monthly principal and interest. This is only related to the loan itself, right? This number does not include all the other ingredients that are in your loan, maybe like mortgage insurance, taxes, homeowners insurance, flood insurance. So this is only pertaining to the loan itself. So that's the principal and interest on a 2.99% interest rate at $240,000. It asks that same question, can that go up? The answer is no. If the rate's not moving, that payment is going to stay true for the duration of the loan. And then the next two parts are really about questions regarding negative features. Is there a prepayment penalty? The answer is no. And for any conventional loan, FHA loan, VA loan, USDA loan, there are no prepayment penalties. So if you won the lottery 3 months after you obtained the loan, you could pay the loan off and not be penalized. So that's a good thing to know. And balloon payment, that just means is the sum of your loan or balance of the loan due before the term, right? This was a feature that was offered during the subprime days where they had loans where they were called like a 30-15 balloon, where it was a payment was amortized over a 30-year loan. So it's as if you're paying a principal and interest payment for 30 years, but the remaining balance of the loan was due in 15 years. I don't think anybody wants to deal with figuring out 15 years from holding a loan that they owe a large amount of money. The good thing is conventional, FHA, VA, USDA, there are no balloon payments, so you don't have to worry about that negative feature. So that kind of summarizes the loan term section. And, just so that you're aware in this example that this is only applying to a conventional loan, right, with this scenario. If there's other types of loans, some of that information would change essentially. Brad, do you have anything that you want to chime in about that section?
No, I mean, I think you're a lot mature in the industry than I am. So
so you don't know the loan.
First of all, my entire year, I've never closed or offered an adjustable rate because it's never made sense, which is you did because you worked in the subprime days, and I've never done a loan that had a prepayment penalty or a balloon payment. So, I mean, I think you pretty much explained everything that we need to explain because for the most part, I mean, we are getting into some non-QM stuff, and I think some of those might come with some prepayment penalties, but not sure about the balloon. But for the most part, most people that are watching this are doing your traditional types of financing that are not going to have a prepayment or a balloon payment. So they really don't apply for the most part.
Yeah.
So yeah, let's move on. So the next section that you're going to explain, obviously, we went over the principal and interest up top. This is kind of the section that breaks down their projected payment. So it's going to show everything.
Right.
It looks like in this example, and you can explain it, but just in this example, it looks like both of these property taxes and homeowners insurance are included in escrow. So I would just mention the fact that in some cases people don't escrow and what this would look like if they were not escrowing.
Yeah. So in this situation, it's pretty cut and dry, but let's start from the top. You have payment calculation in the row, and then to the right of it, it's telling you the years, right? The years that you're going to pay a certain amount of money. And in this case, you have the ingredients that are included now, which will kind of give you an estimate of what your total payment is. So on the left-hand side, you have principal and interest, you have mortgage insurance, you have estimated items that are going to be included in an escrow account. So in this scenario, right, for conventional financing, and we'll get into videos about mortgage insurance, with any conventional loan with 20% down or more, you're not required to have mortgage insurance. So that's why that says 0. If you were to do a conventional loan where you had 10% down, you may have monthly mortgage insurance, and that's where it would show up in that section. So just to go back to principal and interest, you can see at the very top that it matches the principal and interest part in the loan term. So that is kind of flowing down to this section saying that's a portion of what you're going to pay for a total housing obligation. So mortgage insurance is 0. We talked about that. Estimated escrow, that's $735. Now, below, you're going to see another section. We'll talk about it. That's going to describe what's in that escrow section, meaning what is the bank retaining as a piece or a part of your mortgage payment to pay certain items when they're due. Most of the time, you're talking about escrowing for property taxes and homeowners insurance. So you're basically contributing 1/12 of what the annual amount of property taxes are or homeowners insurance every month as a part of that total estimated monthly payment. And then that escrow account is set up for you from the bank to pay those bills when they're due. Taxes and homeowners insurance in this situation. So this is giving you a good idea of what your total housing payment is going to be, and that's going to show up in your mortgage statement. Now, if we look below, it's saying, okay, what are the estimated taxes, insurance, and assessments, right? So this is important because sometimes this can be confusing. In this situation, we're only saying that the only other assessments involved with the payment besides property tax, besides the principal and interest and mortgage insurance at 0, otherwise that would be up in the top section. You're collecting property taxes and insurance only. So this is going to equal the combination of those items, right? So if taxes are $600 a month, homeowners in this case would be $135 a month. And if you look at to the right, it's saying, okay, this is a part of that payment, but is this being collected in escrow, right? So let's just say, for example, the answer to that question is no, right? So if the answer to that question is no, then you're going to see in the above section where it says estimated escrow to the left, to the right of that, Brad, I don't know if you can like delete all the highlighted ones and just highlight the 735 section.
Yeah.
And then highlight the 735 above that. Yep, that figure. Yep. So I want to make sure that they understand that. That would be zero if you're not escrowing for taxes and insurance, but the assessments part would be 735 because you still have that obligation in a monthly figure, right? And that would mean that you are not allowing the bank to collect an escrow account on your behalf to pay those bills, that you elect to pay those bills on your own. And we'll get into the cost section and how that affects the cost section. And in most loan programs like VA, USDA, FHA, in most cases, they're going to require you to have an escrow account regardless of the amount that you put down, right? So conventional is one of the only loan types that allow you to waive escrows. But in my experience, it's most likely going to happen with 20% or more down. So in this case, this borrower could, because they have 40% down payment. And if they chose to elect to waive the escrow account, they could do that. And sometimes there's a cost involved. So you want to be aware, with whoever you're working with lender-wise, that if you wanted to pay your taxes and insurance on your own, there could be a cost involved. But if, let's just say, for example, you wanted to put 10% down, I get questions frequently, can I pay my insurance, my homeowner's insurance on my own? Can I pay my property taxes on my own? In that case, most likely you would not be able to, because you don't have the down payment requirement to waive the escrow account. So that kind of sums up that section. I'm sure I might be missing some things to go over, but for the sake of time, we'll move on to the next section. Did you have any things that you want to chime in about that,
Yeah.
Brad?
I mean, the two things that I think are important, one you already discussed, which is when is it that you cannot have an escrow or waive an escrow account? It's typically, like you said, it's 20% down. You got to make a 20% down payment on a conventional loan. There might be some portfolio products that have other guidelines, regarding that, but that's number one. The other question I get a lot is, which we'll go over in the next section, is the escrow. Like, it's just so you guys know, this money that you're paying, those things are collected in advance. So like when you go to settlement, you're going to see on the next page that we're going to collect 12 months of insurance up front. This escrow is being collected so the next time that bill comes due, you have enough money in the account to make it. And I think that's important because I get that a lot where people ask me, well, you guys are already collecting 12 months insurance. Yeah, that's for today through the next 12 months. But this escrow that we're collecting is when we get 12 months out, we could pay it now for the next 12 months. And then, with taxes in New Jersey, for instance, it's quarterly, or, taxes in PA might be yearly, or whatever the case is. It's going to depend on how often they're paid, how much we collect and stuff like that. So I just wanted to mention that these are paid in advance.
Yeah. So, and for homeowners insurance specifically, a lender wants to make sure that you're covered 12 months in advance. That's why they're collecting enough to cover you if we close today on November 10th, 2021, that you're covered until November 10th, 2022. And the money being collected in escrow is for the next premium due, which would be November of 2022 until November of 2023. So yeah, that's a good point, Brad, that people get confused on, hey, I'm collecting this much in homeowners insurance. Why? I've already paid the premium. I shouldn't have to contribute some more money monthly towards insurance, but that's the reasoning behind it. So let's kind of go to closing costs. Go to that bottom section, Brad, on that first page still, and then we'll just, because it's a simple thing. So this is cost at closing, right? It's saying estimated closing cost are 10,151. So that number is specifically described on the next page of what all your settlement fees are, right? And so just so you know, that's a quick way of understanding how much costs are involved in the loan. And that includes the three main parts of settlement fees, which we'll go over in the next page: lender related fees, title related fees, and prepaid items, which are the establishment of an escrow account, prepayment of insurance, prepayment of property taxes, and interest. And then below that is your estimated cash to close, which is, they're saying if you went to settlement today, this is the check that you'd have to bring to settlement, $170,151. So that's just a quick way of understanding, what do I need to bring to close and what are the closing costs. But with that being said, your loan amount, your loan estimate is just an estimate. It's never going to be exact to the penny of what you're going to need for settlement and what those exact costs are. But this gives you an accurate idea of the amount of cost that you're paying and an accurate idea of what you're going to need to bring to settlement. So let's go to that next page, Brad, because this is the page that I wanted to focus on what are some of the main costs involved with doing a loan. So if you look at the loan cost tab, it's broken down in sections A, B, and C. And this is an easy way for you to understand, what's involved for a loan. So you have lender related fees, anything that the lender's charging you, okay, to offer their services. And we charge $14.95 for our services. And typically that covers our commitment to lend money, overhead costs for a loan, processing, payment of employees. It actually costs a lot of money to do a loan, but that's our fee. And most banks have some type of flat fee, whether it's an application fee, a processing fee, however a lender describes their fees for doing their services, it's usually listed under this section. Some other things I wanted to talk about in this section are discount points. Now, there are no discount points in this situation, but as a consumer, somebody that's buying, or borrowing money or buying a house or refinancing their house, sometimes you have the ability to buy your rate to a lower rate by paying additional costs, right? So for example, we saw, Brad, on the interest rate on this, it's 2.99%. Let's just say that I wanted to pay 1% of my loan amount in discount costs to get my rate lower. That's completely acceptable. And that might give you the ability to get a lower interest rate. It would, otherwise, why would you want to do that? But let's say that 1% additional discount points in cost might get you to a 2.75 interest rate. And depending on your game plan for a mortgage and how long you plan on staying in that loan. Maybe it's an investment property. Maybe this is your forever home and you plan on staying in this loan for a while. It might be worth it. It might be worth to pay to get your rate lower. But that's in Section A are all the related cost and service related and discount points in that Section A. Brad, anything to add to that?
Yeah, I just want to mention something. I mean, this is all for example purposes and everything's negotiable. So I don't want, the origination, the $14.95, as you mentioned, there's cost of doing a loan. So this is covering our costs and we need to charge this to give you the best possible interest rate, right? So we want to give you the best possible interest rate and still meet our profit margin requirements. Otherwise we go out of business. So there are times where we've lowered that or zeroed it out, but it might, require us to charge a slightly higher interest rate. So just keep that in mind, guys, that everything's negotiable and these fees are, all for example purposes today. Everyone's
Right.
situation and scenarios are different. So that's all I wanted to mention.
Great.
I also, which you'll probably dive into moving into the next section, because I'm getting bored over here not talking. So I'll just say a few things. The appraisal fee, which we'll get into, that is shown on the loan estimate as a fee that you're paying, because we have to disclose that as a cost. However, you pay that up front. So it's actually one of the only things found on this document that you're going to pay for prior to closing. So the bottom line number is not going to reflect that amount. It's the bottom line number. The cash to close is going to be all of these costs minus that number, because you've already paid for it in advance.
Yeah,
so,
and I want to add to that, and that goes for any out-of-pocket expenses that are paid prior to settlement, that would be listed on this estimate, right? So let's just say a lender estimates a survey, right? That survey is typically paid prior to settlement, and if you paid that money prior to settlement, it's still going to show up on this document, and that bottom line total cash to close is still going to show that you owe that money. So the loan estimate does not show you what you've paid already out of pocket. It shows you all of the cost involved that the lender is estimating. So that's a good point, Brad.
Yeah, so that will, you'll actually, that's your estimated cash to close, like I said. So that's the full amount of everything paid prior to or at settlement. So if all of these numbers were true, the cash to close wouldn't be 170, 151. It would be the difference of that in the appraisal. So it would be 170, 151, and in this case, minus the 525, which now you'd be bringing to close 169, 626, because you've already paid the 525 up front. The other thing I want to mention about the appraisal fee is that that's going to vary depending on loan program. First of all, how you're going to occupy the home, whether it's a primary residence or an investment property. When you buy an investment property, there's some other documents that are required by the appraisal, like a comparable rent schedule, and things of that nature. So it costs more to get an appraisal for an investment property. There's also a difference in what you pay for an appraisal when doing an FHA loan versus a conventional loan versus a VA loan. So that number, and that's a third party cost. So obviously you could see it's in the section services you cannot shop for. And what that means is that we pick the third parties that we order these things through, but it's entirely up to what they're charging. So your loan estimate, if you were doing, say, a VA loan versus the conventional loan, it's going to reflect a different amount. But whatever that amount is that's reflected on here, that's what you're going to pay at closing, and not a penny more.
Perfect. So just to kind of quickly describe some of those other fees, Section B is lender-related charges, right? Because it's something that you pay for obtaining a loan, but there's services that we order on your behalf that are required for the loan, right? So you can't shop for, and what that means is you can't go out and get your own appraisal. We have to order it through a third-party management company who selects the appraiser at random. You can't go out and give me your own credit report, right? So we have to charge you for those items, but we have to use a service and a vendor for our credit report. Flood certification, that's in order to determine whether your property's in a flood zone. I tell people all the time, it doesn't matter whether you're in the desert, we're still going to order a flood certification to determine that the property's not located in a flood zone. So these fees that are in this section are fees that are related to the loan, but you don't have the ability to pick and choose your own appraisal company, your own credit vendor for credit and flood certification. And those are usually the minor fees associated with financing, in a sense. So let's go to Section C, because these are the other costs involved with financing, which is your title related cost.
I just want to mention one thing about Section B again, that just to be clear about this, these are considered zero tolerance charges. And what that means is no matter what we disclose on here, you're not going to pay a penny more. So for instance, a lot of times with the credit report fee, we might be charging more than it actually costs. So if we charge you $75 and the actual cost ends up being $18, then it's going to reflect $18 on your final settlement sheet. If the cost ends up being $125, then your final settlement sheet is going to reflect $75, because that's what we disclosed, and there's no tolerance here. We cannot increase those charges. So I just wanted to mention that. And that goes for Section A as well. That
Section A as well. I was just going to say that. Yeah. And that, just so people know, that's not an acre mortgage, our bank requirement, that's a federal requirement. So anybody that list cost on this loan estimate for A and B, they're held to those charges. That's important to know, right? They send you out a loan estimate, that's your legal binding contract with the bank that you know that you're safe, because at the time of settlement, that can't change from when they estimated what costs are involved in Section A and B. And we'll elaborate more on Section C. Section C is regarding title charges. So a title company is going to do searches on the property. They're going to have some type of settlement fee involved. They have different line items that, closing protection letter, endorsements. There's different things involved with title, but we kind of lump them up together in these 4 categories. Some lenders break them all down, and sometimes we break them down as well. The largest charge with a title company is the lender's insurance policy, and that protects the lender to make sure that the title company wants to make sure that if the title is transferring from one individual to the next, that the lender's lien position is protected and that there's no other liens carrying over from the previous owner to the new owner, and that the bank has the first lien position to get paid in case somebody defaults on the loan. But just like the other section, right? This is not our company. We're not a title company. We're estimating on behalf of another company's charges. Even though it's not our company or our charges ourselves, we're still subject to a tolerance, right? Just like this other section, these other sections A and B, they're subject to a 0% tolerance, so they have to be exactly right. This section is subject to a 10% tolerance, right? So we have to be very accurate. That means if there's, $2,000 worth of title charges, that when all is said and done, at the very end, when you're bringing your final check to closing and we issue the final closing disclosure, is what that's called, those fees cannot be any more than $2,200. So that protects you as a borrower of money, that that lender is held to those standards, and that even with their estimates, even if they wanted to estimate low, they're still subject to that tolerance because of this document and federal regulations. So I don't know if you want to add anything.
Yeah, well, I was going to say, and that goes to, just in case, that's Section C, that's Section E, and that is Section H. So you'll notice in Section E, there's recording fees and transfer taxes, which are kind of title related. And then you have Section H, which is your title for the owner's title insurance, which is optional. So those 3 sections are that they apply, that 10% tolerance is applied if you're, and correct me if I'm wrong here, if you're using a preferred title company of ours. So if it's a company that we have an affiliate with, then that applies. But if they choose their own and we have no affiliation with them, then there is no tolerance rules that apply. Is that
that I believe that's correct. But the other part to that is Section E, I believe, has 0 tolerance. Like transfer tax, if a state requires transfer tax, and this is happens a lot in Pennsylvania, right? You're to purchase a home in Pennsylvania or purchase a home in a state that has transfer taxes for the buyer, they have to get that right. And I see a lot of estimates where transfer tax is not required, right? For New Jersey, typically, unless indicated in the contract, is not required to pay the seller's transfer tax. And that is the only transfer tax when we're talking about purchasing a home that's required to be paid. It's from the seller's end.
Yeah.
So, and I feel like a lot of companies do that because they estimate that transfer tax because they don't want to get caught being responsible, paying a large amount of money, because sometimes that could be a lot of money. So yeah, transfer taxes are very important to understand, that if you're in a state where the buyer is responsible or the borrower is responsible for paying that transfer tax, there's a 0 tolerance. So the lender would be responsible if it wasn't disclosed properly.
Yeah, and that kind of, just to mention that, like you said, New Jersey, it's the seller's responsible for it. However, in most cases, when we've done bank-owned properties where a buyer is buying a property off of a bank, a lot of times they put verbiage in the contract that, explicitly states that the buyer is going to be responsible for that. In some cases, the buyer doesn't even know. And in some cases, they're very lucky in the past because we didn't catch that in the contract, then didn't disclose it, and then we were left with the bag, right? But now we make it a point that we're thoroughly reviewing every contract for that reason only, because we don't want to, not that reason only, but we don't want to end up paying that money because it can be a lot. But keep that in mind, guys. When you are having a contract negotiated, make sure there's not a clause in it that's requiring you to pay that, at least without your knowledge. If you're in agreement to do that, we're obviously in a very competitive and aggressive market right now. So there's a lot of different things you're seeing in contracts, but that's one thing you at least want to know about, because there are times where we've had conversations and the buyers did not know about that. And it is our job to disclose all fees, and we'll typically disclose that up front. But a lot of times this process is happening after they've already signed a contract. In some cases, we're sending a loan estimate out at the time of pre-approval or before they sign a contract, but we're not going to send a loan estimate out with this fee on it because it's not typical. We're only going to add that fee later once we review the contract and then start working to prepare their initial disclosure. So keep that in mind, guys. Make sure you're reviewing your contract. If your real estate agent's not doing it with you and you don't feel like you're knowledgeable enough to do it yourself, then it might make sense to hire a real estate attorney to go over these legal documents.
Yeah, agreed.
That's my piece.
So let's get to section F, and we'll try to get through the rest of this pretty quickly because we've been on for a while now. Prepaid items and initial escrow payment at closing. So prepaid items are your items that are associated with the property that have to be paid in advance, right? Because that bill for homeowners insurance or property taxes are due prior to your first mortgage payment. So you have homeowners insurance. Anytime you're purchasing a home, they're going to want 12 months paid in advance. That's usually a requirement for most lenders. Property taxes, we have 3 months being collected in prepaid items because in the state of New Jersey, like I said, this is going to change for any state that you, depending on when property taxes are due or what that next bill is going to cost. Taxes are due quarterly in New Jersey. That's 3 months of taxes. That's why we have 3 months listed on this estimate. So that's like saying if taxes are due in December, which they're not, but if they are due in December, we close today, your first mortgage payment is in January. We have to pay that next bill because it's due before your first mortgage payment. The next section is the establishment of the escrow account, right? So this goes over the amount of months of cushion that the bank has to have available in order to pay your bills on time, plus have a certain number of months in cushion. And for most cases, they want to make sure by the time that next bill is due that they have at least at minimum a 2-month cushion. At the time of purchase, we have a maximum of 3. In this case, you see that it's 2 months. Most of the time, when you're talking about a cumulative amount of taxes or insurance in the state of New Jersey, you're most likely not going to pay more than 5 months worth of taxes. That's a bill plus a 2-month cushion.
You might be, just to kind of add to that, because we did in the prepaid section F, yet we put there 3 months, but in some cases it changes. So like you might be closing at the very, very end of a quarter where you might end up reimbursing the seller for that prorated time that you're in the house, right? So like if the fourth quarter, since we're in the fourth quarter right now, if you were closing at the end of December, the seller had already paid October, November, December. So you're going to pay the seller if you close on the 15th, those amount of days from the 15th through the 31st. You're going to pay that prorated amount to taxes. You're going to reimburse the seller, but then the title company is also going to collect another 3 months for the first quarter because the first quarter, it's always due the middle month of that quarter. So the first quarter of 2022, in this year's instant, would be due in February, obviously. So they're going to collect the 3 months for the first quarter and the prorated reimbursement for the seller, which now you're at 3.5 months. And then we might require 2 months to be placed in escrow. So you're around 5, like Craig said, but I just wanted to mention that.
Yeah, and for the savvy borrower, I mean, again, this is just an estimate, but for the most part, if you kind of are trying to justify in your head what are some of the prepaid items or the amount of money that we're going to establish at closing. I would estimate 5 months of taxes in total, 14 months of insurance, 15 months of insurance. That's going to give you a good idea of what you're going to collect between prepaid items and initial escrow account. The only thing that we didn't touch on in this is prepaid interest. So a lot of people ask the question, okay, what is prepaid interest? If you're settling, let's just say in the month of November, and it's the 10th today, and there's 30 days in November, you're going to pay 20 days worth of interest. And the main reason is, okay, and let me preface that by saying that your first mortgage payment is not due until January 1st if you closed today. And that's the reason for that is because January's payment pays all of December's interest. The interest is due in arrears. So if you pay the rest of the days of interest in the month for November at settlement from the 10th until the 30th, that's 20 days of interest. That means that you've already paid the interest that normally December's payment would make. So it's not like you're gaining some money somehow, right? Some people say, oh, I'm skipping a mortgage payment. There's a loophole here. It's really not that. It's you're paying the interest, and the only reason that you're skipping that payment is because you've prepaid that interest that December's payment would normally make. First payment starts in January. So
and also just guys, it's 21 days. So don't let that be a bad.
Or 21 days, including today. I didn't.
Don't forget, dude. I just want people to know that although you're not great at math, you're an awesome mortgage loan officer because sometimes the 2 and 2 don't go together.
Well, look, if I said 21 days, people would have did the same thing. They're looking at the 10th.
I know.
So let's go down to section H. This is in that section, you might have other fees. In this section, you might see fees that are related to the property type, right? A condo, you might have with condos, sometimes they have capital contributions, what they call it. To enter into the association, you have to pay a certain amount of money. In this section, we have an owner's policy. An owner's policy protects the borrower in that situation. I don't know too much about owner's policies, Brad. I don't know if you know a lot about them, but I feel like it protects the buyer in a sense if later down the line there's a mortgage showing up.
Well, it just because, and look, you guys can definitely, call me out on this if I'm wrong, especially if there's some title agents watching this. But my understanding is that as an owner, you might want coverage all the way up to the sales price, where with a lender, we only require coverage to the loan amount. So the lender's title insurance is insuring up to the $240,000 loan, where the sales price is actually $400 in this case. So you'll see when they do separate owners versus lender's title, the higher the percentage of financing, the lower the owner's title policy is going to be, because the lender is already requiring coverage for that higher amount. So that's just my, Yeah,
and you can always talk to a title rep and they can give you details about that, but it protects you. The lender's policy protects the lender. Yeah. So in the next sections, they talk about lender credits. If there were a lender credit somewhere in there, it would be there. But the main premise is that section J totals up all the settlement fees, and that is equal to the first page, that first section of what we looked at, which are the total closing costs. Below that,
I just wanted to mention one last thing before we move on, because I think this is very, very typical for transactions. Most real estate agents or real estate attorneys they're gonna advise you to get a survey. And the survey is where they go out and survey the property, draw the property lines to make sure that you are buying what you think you're buying. There's no encroachments. The neighbor's garage isn't sitting in your backyard, for instance. So that is a typical cost. I would say 9 out of 10 transactions, there is a survey done. You can pay anywhere from $400 to $500, $600, $700 or more, depending on the size of the property and the amount they're surveying. But that would be another cost that would be in this other section that you guys can count on paying, unless you elect not to get one, which most people don't.
Good point. So if we look at the section below that, we're at calculating cash to close. So it's really just adding up and tallying up what we know, right? Your total closing costs. This section, it shows you the down payment from, that we were talking about before, that's not listed on the first page. And you're figuring out what your cash to close is based on tallying up what's owed and any credits that are coming from maybe the seller, from the lender, any money that you've put down on the contract at the time of signing, like what we call the earnest money deposit. It would be listed in this section. And that estimated cash to close is also listed on the first page. So that sums up the closing cost details. Maybe we can quickly go over that next page. And I feel like this is a little bit easier, that next page that kind of gives you the terms. Sorry, Brad's phone's really loud. That happens sometimes.
You can hear it all the way from your office too.
I can hear it now.
All right. So you wanted to move to this section.
Yeah. So this section it's a comparison feature. It tells you what you're going to pay in total cost in a short period of time. And it's telling you, okay, in 5 years, here's how much principal and interest and loan costs you have over that 5 years, right? Your total APR related fees, financing charges, not including prepaid items. Principal you have paid off in 5 years, that's self-explanatory. Not the total payments, but the actual loan balance going down. That's your principal, right? So how much did your loan balance go down in 5 years? Your APR. And even in this section, a lot of people look at the APR and they're like, well, why is my APR higher than my interest rate? Your APR is an indicator, and it tells you all the costs involved with the loans that are related to finance charges. So if you had no finance charges for a loan at all during the short term, at settlement, and through the life of the loan, your note rate and APR would be exactly the same, right? Because you're not paying any additional cost but the interest on the loan. So it's a quick indicator of figuring out, okay, what are my costs involved compared to actually the interest rate that I'm paying, right? So if two lenders are offering the same interest rate, one has a higher APR, that usually is an indicator that there are more finance charges or more APR related fees involved with that lender's estimate. So that's a good, thing to understand. And total interest percentage is the total interest that you're going to pay over the life of the loan, right? I call that gratuity, right? You go to Miami and you have a bill and they're automatically placing that gratuity. You're going to pay 20% gratuity on a bill in Miami. But that's the tip, right? The total interest percentage that you're going to pay over the life of the loan. Now, obviously, in most cases, if you pay more money towards the principal of the loan, and you're going to pay your loan off sooner, so that total interest percentage is going to go down. So that's something good to know, is that you're not locked into paying that total amount of interest. It's all related to how quickly you decide to pay off the loan. There's no prepayment penalty. So if you pay more money towards the principal, you're going to lower that total interest percentage. Brad, you want add anything to that section?
No, I mean, I think you hit it. I think that APR is huge, understanding what that is and how that can help you, because a lot of people want to work with people they know, like, and trust. Like, a lot of our clients aren't shopping us because they know we're going to get the job done. It's going to be a seamless transaction. But more than that, like car dealerships and selling cars online, we have to be aggressive because we'll price ourselves out of the market. So typically we're doing better than most other banks because we understand that in terms of pricing. But the APR is, like you said, it's a great indicator, because like we had a person recently come to us, a friend of mine, who had already got a quote from another bank, and the rate seemed great. But then once we looked at all the costs, they were getting a horrible deal. So we were able to make a better deal for them, right? So without having to go line by line and compare every little thing and try to make a judgment call of where you're getting the best deal, this APR is an indicator of that. Because in this case, we have a 3.06 APR, where they might be able to find a better rate somewhere else, but it might be a 3.75 APR because there's costs involved in getting that rate. So just be conscious of that, guys. If you are out there shopping around, that is the true number you want to work or look at.
That's a really good point. It's a great indicator. So, right, it's your interest rate isn't everything involved with the loan. There's cost involved, and that APR is going to show you the true cost involved. So let's hit the next section because we don't have a lot to go over with this. It's just telling you certain items about considerations. Remember this when borrowing money. In most cases, you're going to need an appraisal. Sometimes you won't need an appraisal because the loan doesn't require it. Or our automated underwriting system is justified that there's a waiver allowed for that particular file. An assumption means, can somebody take over the contract that you have with the bank? They call that the note. So every loan type has the ability to for an assumption clause. Some loans allow assumptions, some loans do not. You're not going to see a lot of these right now, but later down the line, we might, because interest rates could be through the roof and somebody might want to assume the contract that you already have with the bank. I wouldn't worry about that too much, but if anybody brings up assumption when you're talking about purchasing a house or refinancing a house, I would definitely get counsel on what to do in that situation. Homeowners insurance, for the most part, every loan that we offer is going to require homeowners insurance. So that's going to be pretty standard throughout the industry. Late payments, a lot of people too don't understand this, that you have from the 1st to the 15th to make a mortgage payment. Anytime between then between the 1st and 15th of the month is a grace period. So you're not considered late, even though your mortgage payment is due on the 1st of the month. If you are, a percentage of your overdue principal and interest is due to the bank in a late fee. But even more importantly, even if you are late and you decide that I have to pay a late fee, the credit bureaus can't legally mark you late until you're 30 days past due the billing date, which is the 1st of every month for a mortgage. So just understand that. Like, a lot of times people might throw up their hands and say, hey, I'm already late. I'll just make it up in the next month. And it's the 16th or 17th of the month. Don't think that way, because really you might only have to pay a late fee, and you're saving yourself from world of hurt of lowering your credit score and trying to get that back to where your normal credit was. And we'll probably have another video about that. Refinance, it's just telling you some basic disclaimers about a refinance. The property value has a lot to do with it, market conditions. Saying you may not be able to refinance this loan depending on where the market is, right? Obviously, you're not going to refinance out of a 2.99 interest rate for a 30-year fixed if 5 years from now the rates are 5%. That wouldn't make sense to do. And the servicing section is just saying bank you're working with going to collect mortgage payments, right? Are they going to be collecting the mortgage payments that you're paying every month? Now, we're a correspondent lender. We don't service loans. We may collect 1 or 2 payments, but we would end up selling your loan to a different servicing company. Nothing, just so you know, nothing changes with servicing, meaning changes the terms of your loan. If your loan is a fixed rate, your rate stays the same no matter what bank it gets sold to. And, this can happen frequently, loans being sold. It's just a part of your agreement in borrowing money. So that pretty much sums up the loan estimate. Brad, I don't know if you have anything that you want to touch base on before we wrap up the call.
Yeah, Craig, thanks for providing all that information. And yeah, that's pretty much it, guys. There's nothing much I need to say. I think we pretty much went over it. Obviously, like we mentioned, this is for this specific situation. Everything is situational. So we would need to do a thorough review of your finances and see what type of loan you're applying for. And then we can come up with one of these for you so you understand. And this is great because, as you guys can see, this gives you a true picture of what's going on. So you can get something like this during the pre-approval process. In fact, we do something better called a total cost analysis. Craig kind of showed that software last week on last week's live presentation, but we really dive deep to show you all the costs involved so that either if you're ready, you understand going into this, or if you're not ready, you have all the numbers that are needed to prepare yourself, right? So obviously you guys can see there is some money that is required to buy a house. It's typical, it's standard. So the one piece of advice I can give you guys, if you're thinking about it, go out and set up a bank account specifically for your house savings so you can start putting money away so that you're more prepared when it comes time to buy a house. The other thing is a lot of other costs add up. So be cautious of what you're spending your money on and prioritize what's more important, buying a house and owning a house, or going out to dinner on a Wednesday night. So start thinking about those things so you can put more money into that bank account that you're saving for. The other thing I want to mention is that in the text of this live feed, you'll find some links. If you're looking to maybe refinance your home and you would like to explore some options, there's a link provided so that you can do just that. If you fill it out, reach out and do a thorough review of your situation. Same thing for a purchase. If you're thinking about buying a home, there's a link for that. And if you're a referral partner and you're looking to discuss marketing initiatives or learn more about other types of loans, there's a link to schedule a quick 15-minute discovery call with myself. I do want to share a win. I texted a bunch of our agents last week. For those of you that are watching this, and this might be a discussion for another week, we did just approve a client last week using a debt service loan. Very, very cool product. The loan is underwritten based on the appraisal alone. So it's a true investment loan. It's for buying an investment property, but in this specific scenario or this type of loan, we don't need to collect any income or employment financial documents, because the thought is that the rent that the house is going to potentially earn, it's going to allow you to be able to pay the mortgage payment. So Craig, just because you handle that part, just really quick, is it 100%? Like as long as the rent is equal to or greater than the mortgage payment, they qualify, or is it a certain percent?
Yeah, very good question. I think they offer different debt service ratios. So the better pricing is with a higher debt service ratio, up to like 110%. So but they have, even if it doesn't work, they have windows of lower debt service ratios, like down to 80%, 70%. It's just the amount of money put down or the interest rate associated. So just because maybe that particular property doesn't, that rental income doesn't equal out to the mortgage payment, it could be less and you still could do something. It just might not be at the terms that 100% debt service ratio would be.
Cool. So just really quick, I wanted to share that win because that's something cool for us. We've been talking about this non-QM stuff in these, I don't know, out of the box type of loan products. And I just think this is awesome because we had a client who wanted to do a cash out refinance on an investment property. And for one reason or the other, we couldn't show income the traditional way. So we were able to qualify him based on the rent. So if you guys are thinking about getting into the investment game and you want to buy an investment property, but you don't think you have enough income to show to be able to afford that, this is a great product for you. So there's a lot of different products out there. I think maybe we'll do that on a future live call, just talk about all the funky programs we offer, just to let you guys know that we do think outside the box here. But if there's anything we could do, you know how to do it. Email my loan team, call me directly, call Craig directly, messages here on Facebook, or use one of those links provided to get the process started. We appreciate you guys for showing up as always. Hopefully you're getting something out of this, and we'll continue doing it until you tell us to stop. Have a great day. Thanks, Craig, for all the information and joining us, man.
Take care, guys.
All right, guys.